what the price might be, this is what my expected price will be, and I know what the asset is. I know all the asset price underneath. You know everything about the asset price.
No, you only know the price for this specific contract. You don't know any other price, so you don't know that if this price is fairly priced or just like you give the.
Do we know anything is fairly priced? It's completely subjective,
You
right?
can refer to the bond market or stock market. All the price is published.
The efficient market hypothesis. Assets are priced on based on complete information in the marketplace. What you know is what prices that stock.
Yes, but that's what I'm going to say because the condition in the derivatives market does not satisfy the condition for the effective market hypothesis at all. Because first, it's not transparent. Second, it's not completely competitive.
What is that?
Because you said if it's an effective market, the new information cannot change the price at all because the market is always ahead of this.
Which is fine. And
Right,
what's the problem?
but it's not happening in the derivatives market.
It hasn't? Can you give me an example?
Uh-huh.
Could you give me an example?
Yeah, like the CDS prices.
Well, was that because of the CDSs themselves? Was that because of credit default swaps? Now, in a perfect world, you could say, let's just say there was no asset bubble in 2008. There was no housing price bubble. Now, would these financial derivatives, would we ever have this negative connotation if it didn't blow up? If the interest rates weren't so low for the longest time, credit default swaps, they're an ingenious thing. They allow people to go and break up risk. They like to break up risk. So people that want the risk, want the return, are allocated, and they have the chance of losing that money. They know that. They know that. However, in 2008, let's eliminate that crisis from history. It's just not there. Do you think we'd be having this discussion today?
No.
What's that got to do with you?
Sure. Well, the thing is, we have this whole thing where derivatives need to be regulated, but this debate only started after 2008.
Why is that?
Because of the fact we had the whole bailout of banks, we had there was that whole idea where credit default swaps were kind of like.
That's not true. Lots of people were concerned with the Ronald Reagan approach to free enterprise in the derivative market years before 2008.
Well, that's where the 1999 Glass-Steagall Act came in, which allowed.
That debate had been going on for 15 years.
Well, the biggest thing was that lately, the most concurrent.
I mean, it may have triggered it.
How can you, I think you were arguing the same point, right, before
Yes.
change.
I'll let you continue.
So can you,
On the derivatives, on why we're having an argument about it after 2008. Well, because we had a discussion about it in class actually, the fact that these credit default swaps, they existed because, well, the housing bubble was such a perfect example because they had all these mortgage-backed securities all combined into this big AAA asset. And because the likelihood of all of a sudden of all of these mortgages defaulting simultaneously was, well, what we thought was zero, which turned out to be higher than that. But this wasn't because it wasn't a regulated market. It was because all of a sudden this freak housing bubble collapse happened, and that's when we had to bail out.
Do you know why the housing bubble collapsed?
Do I know why?
The exact reason. The tipping
Average.
point.
It was because all of a sudden the banks were giving subprime mortgages.
Interest rates went up.
That caused the bubble, but it didn't cause the burst. I asked this in class. I'm asking a question for which I don't know the answer.
Okay. That was my
Unusual
situation.
One variable would have been the rise of the interest rates, creating the people that, these mortgages, these mortgage-based assets were based off of. So now that the interest rates were going up, and that the
So
percentage.
did interest rates actually trigger the bubble?
Well, they're definitely a variable that aided in bursting the bubble.
So if there were resolutions, would there have been a smaller downturn during recessions?
Well, we beg that question. If these weren't there, then there wouldn't be this big of flow of capital. Like when we're.
Yeah, so would there have been a smaller drop because of the recession?
I don't think you put it on there.
That's,
Okay, I
That's
got
speculation.
yeah.
Then why are people turning towards thinking about regulations after the recession? They
Because
must believe that there is a correlation. Right?
once
They must believe that.
a crisis happens, we need to, everyone's searching for a cause immediately, right?
The
So,
government is here to show people the basic of why the government intervenes because that's a solution. The government has to solve it. That's the whole point.
and the fact that,
Why not actually turn towards saying that maybe we need to fuel it further, not regulate it? You're saying they just look for an answer, and this was the answer they looked for.
Well,
Why didn't they look for an answer which was exactly the opposite to that?
Like what?
Like, let's fuel it further, let's make it easier for them to.
Oh, because you can't, well, I mean, there's no way to fuel the derivative market further. Like, if you look at the total value of the derivative market, it's something, in 2012, it's something like over $600 trillion, which is,
Maybe they can subsidize when they borrow this money.
pardon?
Maybe they can subsidize it.
Why would they do that?
Hmm?
The government?
Yeah, I mean, why, so good, I'm just debating the answer that you gave us. So I'm saying, after the recession, why did they start thinking about regulations? You said, well, they had to look for an answer. So I said, well, because if that's the only thing, some answer, instead of regulations, why didn't they say, hey, you know what, we're gonna make it easier for you?
Why
I
this
can answer that because,
opposed to another answer?
well, because they saw the rate at which this derivative market was growing. And so that was immediately, they thought, okay, well, if suddenly this market goes from, I believe the number was 17 trillion to 638 trillion in 3 years, obviously there needs to be some kind of regulation because something like this can't accelerate that fast. But we're arguing against that because it's the whole leveraging of capital which creates
Maximizing
this kind of gamble.
You still want lending
Okay.
market?
Mhm.
Time. I'm going to give Phil an opportunity to pull your side together, and then I'm going to give Mr. Newman time to pull your side together. Shorter the better. Phil? So what you want to do now is nail it. You want to nail it, right? So you want to convince me that regulating derivative markets is a good idea. So you might want to help me out with what regulating means. I still don't know what it means. Transparency is a part, but that one, I can't see why you wouldn't want transparency, right? Because you want full knowledge for the market to be efficient. So if you're defining regulation like that, I think you have to concede that regulation is good. Good point. Fiona?
Okay, so ideally, government regulation will explicitly state a broad code of conduct instead of creating a complicated framework that confuses policy while, like the Dodd-Frank Act. Like, there are some good aspects of it, like the requirement of clearinghouses, so there's more transparency because the firms are required to report on their trades. But there were a lot of like minutiae added on later on where they were like, oh, what about this specific example or another one? Like, there was just a lot of extra like side notes on top of the policy. Like, essentially, it would guarantee transparency, competition, and accountability while preventing systemic risks, or at least reducing them, without dictating the market behavior of the derivative market.
Okay, thanks, Fiona. Mr. Nguyen?
Alright, so we want to underline the idea of a free market. As you said, that free market works. So we have supported the idea by comparing the unregulated derivative market with the regulated markets. And the results have shown that even though that the regulated market has been growing, it is still in the shadow of the auto. So as we mentioned before, the true nature of unregulated derivative market, unregulated derivatives, is that it creates surplus and helps our entire system hedge and leverage against the price uncertainty. So we again want to emphasize that government regulation will cause moral hazard. So, and more importantly, winners and losers will be picked by the government hand. So, which is contrary to the idea of a perfectly competitive market, which is an efficient market. So, furthermore, that credit default swaps, interest rate swaps, future option, and other instruments allow wealth to be passed off efficiently and aid those in allocating against uncertainty in the world that we know today. Regulating these financial instruments due to its complexity would simply eliminate market efficiency. So
Yeah, it's government intervention in an otherwise free market.
Is it a free market? That's not the point. And that's what they are trying to say as well. Is it a free market?
Well,
Is it a market
all
just-
markets are free until the government intervenes.
Yes, but if you have a market which is already controlled or is already affected by other external factors like bailouts, then you don't have a free market. And the solution is when you don't have a free market, what is the solution?
Don't fail
So
it.
but do you have a situation like that? If you had a situation like that, then you can say, yes, we don't need regulations because it's a properly functioning market, but it isn't. Right? So given the state right now that we are in, do we need regulations or not? And the state that we're in right now is that there is bailout. Right? So given the
There
state,
was a
what is the...
There aren't bailout after bailout, there's only one.
So the government could go on record saying, we're not bailing you.
Well, when that happens, then you need to ask for in that state, what is the optimum? Is it regulations optimum or not?
Okay, I agree.
Can I just make one remark?
I'm going to leave it to our chief judge, who's a student, Albert, Royal Albert.
May I make one remark?
Submissions are over. Thank you. You can send me an email. Albert, what do you think?
I can say this till I'm blue in the face, but a good point badly argued is no point at all, and so I'm gonna have to give it to the guys on this one.
Say that, a good point badly argued
Is basically no
is
point at all.
no point at all. Did you make that up?
I'm paraphrasing Christopher Hitchens.
A good point,
Or insufficiently
a
argued.
good point
You get a trademark.
argued is no point at all.
Yeah.
So who made the good
From
point?
Robert
To whom does that apply? Who had the good point?
The guys made some they presented their arguments for the efficiency of a derivative.
So they had a good point, but it's no point at all.
No.
No.
Please give it to them so that they...
I'm saying they had the better points on paper. I did not argue for it as well as the guys argued for their points.
So you think that on paper regulation is a good idea?
Oh, yeah. But what
Okay,
I think
okay,
is
I
relevant to
understand,
the
I
debate.
understand. Professor Malhotra, how would you vote on that, actually? I'll tell you how I would vote. I would, well, you know how I would vote. Get rid of the bailout, and then you don't need to regulate.
But that's not the point that is being argued here, right? The point that
No, the
being
point
argued
being
is,
argued
do we
is
need
you need to
regulations?
regulate.
Do we need the regulations?
And my answer
given
is
the
no, you
state of
don't.
mind- Given the state that we are in right now,
You don't have to regulate.
if it's sufficient market, then you don't. But it's
Speaking
not
of
sufficient
regulating,
market.
I have to regulate certain bodily.
Okay.